This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 5, 2026, and this is the New York session. Now, let's get into it. Spot gold has surged past $4,100, climbing 14 basis points in a single session to $4,131.09. The Fear and Greed Index is flashing extreme fear at 14 out of 100, yet the VIX remains eerily suppressed at 15.86. We are witnessing a structural divergence in the Forex market where safe haven flows are accelerating while volatility metrics suggest calm, creating a complex backdrop for the US dollar and its major pairs. Turning to the schedule, the market's eyes are fixed on the UK Monetary Policy Committee. On Thursday, August 6th, the Bank of England announces its interest rate decision at 1200 hours UTC. Given the recent dramatic unwinding of British pound positioning by leveraged funds, the Bank of England's statement will be scrutinized for any hint of dovish pivots or hawkish reassurances regarding persistent inflation. Also on tap for Thursday morning are U.S. weekly initial jobless claims, serving as a secondary check on the labor market softness signaled earlier today. And finally, looming large for Friday is the non-farm payrolls release, the definitive test to see if today's ADP disappointment was an anomaly or a trend.
And for the Bank of England decision specifically, watch the language around wage growth. With the pound having lost 40,000 contracts in leverage overnight, the market is bracing for a surprise in the direction of the pound's trajectory, regardless of the rate outcome itself.
Here is the snapshot as of 9:29 Eastern Time. The global mood is decidedly risk-off. Gold leads the charge at $4,131, plus 1.44%. The US dollar is broadly weaker, though not uniformly. Dollar-yen is down 0.18% to 157.4200, while euro-dollar holds steady at 1.1538. Meanwhile, Aussie dollar sits at 0.7050, and dollar Swiss is at 0.807775. The yield curve is flat, the ADP report missed expectations, and central banks are sending mixed signals. Let's dig into the headlines driving this flow. First, the labor market data came in at plus 44,000 ADP jobs against a plus 70,000 consensus. That miss is the bedrock of today's risk-off tone. Second, Minneapolis Fed President Kashkari suggested the Fed would prefer small hikes now, a hawkish stance that clashes with the softer economic data. Third, gold has surged above $4,100 as expectations for a US-Iran deal reduce long-term inflation and Fed tightening risk. How are we interpreting this clash between Kashkari's hawkish rhetoric and the soft ADP print? It's a classic policy trap. You have a Fed official advocating for tighter conditions, while the actual labor data, plus 44,000 jobs, signals a cooling economy that cannot sustain further tightening without crushing real GDP growth, which is already sluggish at 1.50% annualized. The market is essentially voting with its wallet against the narrative. Traders aren't listening to the small hikes comment because the underlying data supports a pause or pivot to prevent stagnation. The disconnect between the Fed's desired path and the economic reality is the primary engine of dollar weakness right now. So the market is ignoring the hawk in favor of the data. Exactly. The plus 44,000 figure is the truth. The speech is just noise. That divergence forces a repricing of terminal rates lower. Let's start our deep dive with the standout performer of the day, gold. It is trading at $4,131, up 1.44%. Grid, this looks like a technical breakout. Where are we standing relative to structure?
We are absolutely in breakout territory. Spot gold has decisively cleared the $4,100 psychological barrier. The current price of $4,131 is trading within 1.2% of today's absolute peak of $4,136.67. Crucially, there is no upper shadow rejection yet. The structure has established a new higher-low foundation, having closed above the previous 5-day high of $4,107.29 from July 3rd. The momentum here is clean. Buyers are stepping in at every dip.
CIPHER, what are the flows telling us behind this move? Is this speculative mania or institutional allocation?
This is institutional allocation, and it's aggressive. Look at the broader safe haven rotation. While gold is the hero here, the COT data shows leveraged funds have shifted massively toward the yen, adding over 100,000 contracts week over week. But importantly for gold, capital is fleeing dollar-denominated risk assets and moving into non-correlated stores of value. The plus 1.44% move isn't random. It's a flight to safety triggered by the fear and greed index hitting 14 out of 100. You have capital preserving wealth in hard assets because the fiat denominator, the US dollar, is losing credibility amid that ADP miss and the Iran deal speculation.
SPECTER, with the VIX at 15.86, is the low volatility regime dangerous here?
Extremely. You have a dangerous decoupling. The VIX is suppressing at 15.86, well within its 5-day range of 15.54 to 20.88, yet the fear and greed index is screaming at 14 out of 100. This implies that portfolios are underexposed to downside risk. The low VIX is artificial. It masks the structural fragility caused by the ADP miss. If a second negative data point hits, like weak jobless claims on Thursday, that low VIX will snap back violently. Right now, you're accumulating gold without paying for tail risk insurance in options.
Grid, do you see any immediate resistance threatening this breakout?
Not immediately. The price is riding the highs. The key level to monitor is whether it can hold above the 4,100 mark as a support floor. If we get a pullback, that 4,100 becomes the bid. But as long as we are near the 4,136 high, the structure is bullish.
Moving on to the pair under maximum scrutiny, dollar-yen. It's down 0.18% to 157.4200. Headlines are questioning potential US-Japan joint intervention. Grid, walk us through the technical defense line here.
This is a do-or-die level for bulls. Dollar-yen is currently at 157.4200. sitting just 12 pips above the lower bound of the critical intervention zone, which we've identified at 157.30. Earlier today, the low touched 157.306, meaning price literally brushed the threshold of the algorithmic intervention triggers before snapping back. The structure is fragile. A confirmed daily close below 157.30 would invalidate the current consolidation and open a direct channel to the 5-day low of 155.229. We are hovering on the edge.
CIPHER, does the flow support the idea that intervention is likely, or is this purely speculative positioning?
It's both, but the flow is undeniable. Leveraged funds have added 103,259 contracts to yen longs week over week, shifting from neutral to a net positive 1,269 longs. This is not retail noise. This is smart money front-running Bank of Japan intervention or structural dollar debasement. They are positioning for a breakdown below 157.30. When you combine this massive influx of yen leverage with the headline risk of joint intervention, the probability of a sharp move lower increases significantly. The institutions are betting that the Fed is trapped.
And they are betting correctly on the trap. Kashkari wants hikes, but the ADP data says no. The BOJ sees a weakening U.S. economy and intervenes to protect their exporters. The convergence of weak U.S. labor data and proactive Japanese defense of their currency creates a perfect storm for dollar-yen. SPECTER, is there a risk that the low volatility environment causes a false break here?
That's the danger. Because volatility is so low, stop-loss clusters are thin. A quick spike above 157.50 could trigger a wave of long dollar-yen entries, only to be crushed when the 157.30 support fails. The low VIX means there's little cushion. If the intervention threat materializes, the move won't be a slow grind. It'll be a liquidity grab. You need to be wary of the calm, before the storm compression we're seeing in the VIX.
Let's turn to the British pound cable. It's trading at 1.34567, up 0.05%. With the Bank of England decision on Thursday, we're seeing some consolidation. Grid, what does the chart look like ahead of this event?
It's a compression squeeze. Cable is tightly packed between the 5-day low of 1.34003 and the 5-day high of 1.35065. The current price of 1.34567 is essentially dead center in that range. There's no directional conviction yet. The market is waiting for the catalyst. Technically, a break above 1.35065 would signal a move toward the upper bands, while a break below 1.34003 exposes the lower side. It's a coiled spring.
CIPHER, why is the pound consolidating instead of trending? We saw massive positioning changes overnight.
Because the positioning has collapsed, leveraged funds dumped 40,644 contracts in pound week over week. Net exposure dropped to just 453 longs. This is a deleveraging event. Institutions are exiting carry trades ahead of the Bank of England decision because they don't want to be caught on the wrong side of the announcement. This massive unwind creates a liquidity vacuum, without the big players holding large directional bets. The price action is choppy and range-bound until the actual vote drops.
So we're watching for a volatility explosion on Thursday.
Precisely. The absence of positioning means the move will be dictated entirely by the Bank of England statement and the governor's press conference. Late entrants will be punished.
Finally, let's look at the commodity currencies, specifically Aussie dollar. It's at 0.70500, up 0.05%. It seems resilient compared to the broader dollar weakness. Grid, does it hold?
It does. Aussie dollar is holding at 0.7050, effectively reclaiming yesterday's close of 0.70465. More importantly, it is holding firmly above the 5-day low of 0.69839. This structural integrity contrasts sharply with the dollar weakness we saw in yen and Swiss franc pairs. The support at 0.69839 is holding, suggesting that despite the global risk-off tone, there is still bid support here.
CIPHER, this is interesting. The broader market is fearful, fear, and greed at 14, yet Aussie remains strongly bullish in COT data. Net leveraged funds are at positive 27,618. Isn't that a contradiction?
It is a glaring contradiction, and it's a trap. While the macro sentiment is fearful, speculative leverage remains entrenched in Aussie longs. This is a crowded long side vulnerable to further risk-off liquidation. If the ADP miss turns out to be part of a broader downturn, or if risk appetite evaporates completely, those 27,000 contracts could become a fire sale. The fact that Aussie is holding up right now might just be lagging the broader sentiment shift. It's the poster child for delayed reaction risk.
SPECTER, do you agree that this is a trap?
Absolutely. You have a situation where the fear and greed index is at 14, yet Aussie positioning is highly bullish. The VIX is at 15.86, hiding the risk. If the U.S. labor market deteriorates further, as the non-farm payrolls forecast suggests, that Aussie long position becomes toxic. The divergence between price and positioning is your biggest warning sign. The market is rewarding audacity right now, but the fundamentals are turning.
Apex, tie this together. We have gold breaking out, dollar-yen defending intervention zones with massive yen leverage flowing in, and cable squeezed tight by deleveraging. What is the dominant theme?
The dominant theme is narrative failure. The Fed's narrative of necessary tightening has failed against the ADP data. Pulse highlighted how the plus 44,000 job count overrides Kashkari's hawkish comments. Grid showed how gold has broken technical resistance precisely because the market is abandoning the dollar narrative. CIPHER confirmed that institutions are fleeing dollar-linked assets, dumping pound and pouring into yen, to align with this new reality. However, SPECTER warns that the low VIX and Aussie's stubborn bullish positioning suggest the market is complacent about how fast this correction could accelerate. The data shows a dollar that is structurally weakened, but the tools to measure that stress are currently blindfolded.
To summarize the pre-market picture, gold is leading the safe haven rally, breaking above $4,100 as the market rejects Fed hawkishness in favor of economic reality. Dollar-yen is under intense pressure near the 157.30 intervention line, supported by massive institutional yen leverage. And cable is in a pre-Bank of England consolidation, having shed significant leverage, setting the stage for potential volatility on Thursday. Tomorrow, keep an eye on U.S. jobless claims for confirmation of the labor softness and prepare for the Bank of England decision to shake out the sterling positioning. This is ShadowQuant Forex edition, analyzing the data, not predicting the future. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.